So hello everyone, and I hope everyone is well. So we proceed on to chapter 9 now. And chapter 9, the main topic of chapter 9 is the cost of capital for a company. And it could be for you too, right? So the cost of capital is simply let me highlight this because this is an important sentence. All right, I'm going to highlight this. All right. This represents the cost of financing and is the minimum rate of return that a project must earn to increase the firm's value. So basically, this would be like you getting a mortgage or a student loan, right? And basically, on the other hand, if you were going to invest in something personally, this is the basically you want to increase your value, personal value. And this is the minimum rate of return that a project must earn to increase your value. So let's say you've got a mortgage or a loan that's you're paying 4% on. Obviously, you'd like to get a investment that's going to pay more than 4%. So it increases your value, right? You also always want a rate that's higher than inflation, because if you don't get a rate higher than inflation, then basically you're not increasing your value, right? Your money's losing buying power. All right, so what's the definition of capital? Capital is a company's long-term sources of financing, which include both debt and equity. Okay, so that includes both debt and equity. So debt and equity is what? Stocks and bonds, right? Everyone knows that at this point, right? Capital structure is the mix of debt and equity financing that a firm employs. So basically, how much debt are you taking percentage-wise, and how much equity are you taking percentage-wise, right? So you're setting up a structure, right? All right, so the basic concept of is the weighted average cost of capital. So the weighted average cost of capital is the combination of basically your company's breakdown of debt and equity. So it's an average of a weighted average of your company's debt and equity financing, where the weights reflect the percentage of each type of financing used by the firm. So again, it's like, it has to add up to 100, right? And maybe you got 40% debt and 60% equity. And I think everyone knows where I'm going with that, right? So, um, so it's that breakdown, right? And it always adds up to 100%, right? So here's a company's capital structure, right? Of different companies here. There's different companies. So everyone knows Alphabet is Google, right? And this is Johnson and Johnson and Procter and Gamble. And here's their outstanding debt, right? Here's all their. You notice how much debt GE has. GE's in trouble. So here's GE's outstanding debt, and this is their percentage of debt. And here's their equity, and here's their percentage of equity. So you notice this always adds up to 100, right? Look, 1 and 99, 94 and 6. So it's always got to be 100, right? So I just wanted to make sure everyone's aware of that. So the debt and equity totals, and then the total, you'll notice here, 647.40. I believe that should add up to that, and that should add up to that, right? So you add the outstanding debt and the outstanding equity, and that's your total capital. Okay? So if anybody has any questions, please let me know. All right, so a company is currently considering two investment opportunities. Two financial analysts working independently of each evaluating these opportunities. Investment A, the cost is $100,000, and life is 20 years, and the expected return is 7%. The analyst studying this investment recalls that the company recently issued bonds paying the 6% rate of return. He reasons that because of the investment project earns 7%, while the firm can issue debt at 6%, right? You see the difference there, right? He's making money. The project must be worth doing. So he recommends that the company undertake this investment. Okay, so that's his reasoning there, okay? So he's got his reasoning going. And here's investment B. So he knows he's got common stock outstanding, right? And then investors who hold the company's stock exceed a 14% return on their investment. The analyst decides that the firm should not undertake this investment because it produces only a 12% return, while the company's shareholders expect a 14% return. So you notice the word expect. They expect a 14% return, right? I like that word. They expect 14%. Whoop, what happened here? So let's say they expect, and here they expect. So all right. So they expect a 14% return. So each analyst is making a mistake by focusing on one source of financing. So you can see it's the combination that's important, right? Rather than the overall mix. What if instead the analysts used the combined cost of financing? So let's look here for a minute. Assuming this firm desires a 50-50 mix of debt and equity, the weighted average cost of capital is going to be 10% for the debt, right? 3% for the debt and 7% for the equity, so it's really only 10%. With this average cost of financing, the firm should reject the first opportunity at 7% is less than 10 and accept the second, right? 12%, right? So you can see you can't just focus on one cost there. You have to look at the combination of the two, right? So your cost of capital is 10%, right? And you would accept the second project because you got a 12% expected return. So it's important to look at all factors when. All right, so here's an overview of the cost of capital. Basically, this is a very, very simplified balance sheet. So long-term capital, right? Long-term comes from four places, right? Long-term bonds, like 20 or 30-year bonds, preferred stock, common stock, and retained earnings. Retained earnings is money that belongs to stockholders in dividends that you never gave back. So not every firm will use all of these financing sources, okay? So here's a simplified balance sheet. So here's the sources of long-term capital. So the cost of long-term debt is the interest rate that the financing cost associated with paying coupons to the bondholders, right? And net proceeds is the funds actually received by the company, because what'll happen is the investment bank takes a portion of the money, right? So if you're going to borrow 10 million, let's say, you'll only get 9.5 million because the investment bank will take, like a 500,000 or so, right? So it's the net proceeds, right? And that's what this is here. The flotation cost is part of the cost that the investment bank takes. So you won't get your 10 million or 20 million. You'll get something a little bit less, so they can take their cut. Okay, so I just want to make sure that's clear to everybody there with those terms. So here's another example here of Duchess Corporation, a major hardware manufacturer, is contemplating selling $10 million worth of 20-year. This is the maturity now, right? 20-year bonds, right? This is the par value, right? 6% coupon. That's the interest they're going to pay. All right. So they're going to pay $60,000 in interest every year, and each of the individual bonds has a par value of $1,000, right? Because bonds with a similar risk earns interest equal to 6%, Dutchess bonds will sell in the market at par value, and they will have a yield to maturity equal to the coupon rate of 6%, okay? That's going to change, of course, as time goes on, as the price fluctuates up and down. However, Dutchess will incur, now here's the flotation costs, right, equal to 2%. So this is the flotation cost that they've got to pay the investment bank, okay? So that's how that goes. So $20 per bank. So the net proceeds to the firm from the sale of each bond are $980. Okay, so you take that into account. Okay, so there's before tax and after tax. So we got to talk about before tax and after tax. So the before tax cost of debt, RD, before you pay taxes, right, is simply the rate of return the firm must pay on new borrowing, right? So that's the coupon rate, right? So you can look at a quick method for finding the before tax cost of debt is you look at the yield to maturity on the existing bonds. Okay, so basically, one must basically calculate the yield to maturity to figure out how much you got to pay the bondholders in debt. Now, when you pay them that coupon interest rate, right? After you pay that interest to the bondholders, you're allowed to write that off on your taxes as a company, right? So it lowers your tax base. So that's called the after tax. So we're going to distinguish between the before tax cost of debt and the after tax cost of debt. So here's an example here of a company paying with flotation costs, and they're basically going to pay coupons out. So here's the cash flows. This is the money that they got, and then here's the coupons going out, 6%, right, for 20 years, and then you get your money back on. They have to pay you back your money when the bond matures. Okay, so here's the cash flows. Okay, so you can calculate the yield to maturity with a financial calculator, or you can just use Microsoft and Excel and use the rate function. There's a function called rate, R-A-T-E, a rate function in Excel that you can use. Oh, so here's the spreadsheet as I was saying, and here it is right here. So here's the rate function for Excel, and you could use this to basically get the before tax cost of debt, okay? And you should try it. Just go into Excel, go into the rate function, and pop those numbers in. And I believe on the next slide they've got an example. So here it is. So here's Excel's rate function, and here's the par value. You put that in as minus 1,000, and here's the coupon rate, and here's the interest payment, and here's the number of years to maturity, right? And here's your net proceeds. So here, and you get the yield before tax cost of debt. All right, so if you don't want to use Excel, this is an approximate. Now, I just want to say this is an approximate equation you can use to get the same thing. If you're not comfortable with Excel, you can just pop the numbers in here in this equation. And you see it says here, the value can be approximated, okay? And you just pop all the numbers into this function, okay? So here they are popping the numbers in, and you can see you get pretty close. You get pretty close. Now, after you got the before tax cost of debt, there's what's known as I mentioned already, the after tax cost of debt. And all you got to basically do is take your debt and multiply it by the tax rate, okay? And that'll lower basically your after-tax cost of debt, okay? So this is an important, simple equation. It's your basically your cost of debt before tax times your tax rate, and that'll give you your after-tax cost of debt. All right, so I'm going to end. Basically, I'll end here. I'll go over this slide next. So I'll make this part one, all right, and then we'll pick up in our part two.